Okay. Are we live?
We're about to be. All right, here we go.
Okay, I see it.
We we are live. I'm actually going to share this to our Twitter users because we're very proudly on time today.
Yep.
Um, and we even have we even have a second to tell people.
Yeah, we'll make sure everybody gets in here because we're going to be giving out some good information today. People are going to want to see
As
this.
opposed to normal when there's no good information. Today's the good stuff. All right. Great. Oh yeah, that is like much more crisp. Is that even too much light? I'm wondering.
I think mine just might be a little dark since it's so rainy out today near me. I don't know if I should try. Here, let me turn on a light. Let me see if this doesn't.
Yeah, mine is looking
All right. I turned on
almost
the light.
almost too bright today, but whatever. If I'm too well lit, that's no problem. All right, let's just jump in.
Well, your
We're
skin
we're
looks
live
better.
on time today. We're gonna go.
You
Let's
must be
do it.
using Elf beauty
A
products.
lot to
We'll get
talk
into that
about.
later. um, yeah, so we're back. It's another Prospero.ai update, and this is a big one because there was a lot of things happening last week, a big switch up in the market and the Prospero.ai idea and on the market. So you want to inform everybody, George, if they haven't already seen?
Yes. So essentially what I was seeing, and we first saw it on 723, that and I'm not even going to pretend I even knew what this was the whole time, but I'll tell you the whole story. Basically on 723 in our letter, I reported that it was kind of weird to be seeing a convergence between SPY net option sentiment and QQQ net option sentiment. And that is something that I'd never seen. But I had just taken that to maybe mean more that the bullishness on the SPY was coming up, which is, kind of how I was considering it originally. And that's, what the market signals generally and what I was seeing in terms of like tech stocks still remaining relatively bullish. But what we saw over the course of the next few weeks and what I kind of sounded the alarm on market open was the first time I've ever in 47 letters updated the weekly picks midweek. And that was just purely a function of seeing something that I was not too happy with and kind of figuring out what I thought that meant. And it looked like what it absolutely did mean. And so we were able to get you like a bear signal, I would say a lot earlier than most. And when we posted this thing on Twitter, it was pretty funny. I sounded the alarm at 9:30. Prospero net option sentiment on the QQQ at 9:36 reported the same thing. So I was happy that even though I was aware of it before, Prospero was like right behind me in terms of just like a huge bear flag right after I sent the update. And then bar chart, which is obviously dealing with significantly more resources than us, was about 2.5 hours behind us reporting that. So that was pretty cool and kind of an advertisement for, how these signals are really differentiated in terms of how clear they can make things sometimes. But basically what I saw in that convergence was basically like, as I thought about it more and as I read, a Wall Street Journal article that kind of clicked for me as I was watching it, was seeing that forward earnings on the S&P 500 was trading at 19.7 times, which is basically aggregating all of the forecasts for the companies in the S&P 500 and just basically creating a giant PE ratio, forward PE ratio out of those stocks. And I had noticed that earlier this year, it was in the 17s. And then on the 5-year average, even in the huge bull markets, the average was 18.6. So I was like, whoa, we are getting way overvalued in the market. And that's when it was like, oh, wait. And this thing that has been like setting up alarm bells in my brain where SPY net option sentiment and QQQ net option sentiment is converging, it makes sense why that is really affecting me, because growth stocks should not be as, the S&P 500 should not be as speculated on as tech growth stocks in the options markets. It means people think tech is way overvalued if those numbers are converging. And luckily, we can look for that in the future as a very meaningful sign. Now that I've kind of had this game to play in my mind. But yeah, it just made this super obvious. And it's like one of those things where there's just really valuable information in Prospero. And traditionally, it's used on stock picks, even though last year, most of the money that we made when we were, essentially over 200% annualized with the newsletter picks, a lot of that was actually trading the QQQ. So we kind of are going back to the roots of how I first made a lot of money in the trades. Here, this year has been really looking at what I saw was a bull market. What I saw was undervalued tech stocks, and I expected them to take them for a ride. And obviously, we've done that with Tesla, Meta, Alibaba, Amazon. So that thesis was right. But then as we saw that, I was like, no, we need to totally change this around. This stuff is overvalued. We have, earnings agreeing with that. We have option sentiment agreeing with that. Normally, when earnings agree with something being overvalued and something like option sentiment that is a completely different source, seeing something is overvalued, I'm like, oh, that's why I made an exception and sounded the alarm and completely flipped the portfolios, because that was just a huge, obvious signal to me at that point that things needed to change in our portfolio and things were about to change quickly in the market. And we were absolutely right.
Yeah, so I really want to dive into this stance because it's such a big switch up, and I want to talk about a few stocks that are related to this new bearish stance and how long this is going to be lasting. But let's start off with Apple, the biggest company in the US stock market. And they reported earnings, and they're now down, I think, over 10% since just last week. So is this just Apple got too overvalued, or what's going on with Apple stock?
Well, I would say there's concerning trends in Apple's business. And I'm actually in the process, and I owe my paid newsletter readers a bit of a research report on Apple versus Google, because I think this particular point is really interesting in contrasting those companies, because I was talking about how like Google was a great value relative to Microsoft and relative to Apple. And since I've been talking about that, those have definitely converged. And a lot of it I've talked about right here in this live stream. But I would say like what is happening, Apple's revenue has been down, I think it said 3 or 4 quarters in a row, year over year. And, you contrast that with Google, where everybody's like so worried about it. And their revenue, they reported up 7%. And I think Google was something that was, down, but you can't always just look at that. iPhone sales are down, which is a big problem. And if you're seeing like a core business, like iPhones are such a big part of their business. If you see that, start to falter, then, you begin to get concerned about, some of the things that are happening. And I would say not only iPhone sales, like, Apple is talking about being an AI a lot. And obviously they were very early to like that kind of game with Siri. But if the expectation is that Siri is no longer a competitive technology with, something that Google makes or something that, Microsoft makes or whatever. And if that's the concern, because they really like, while they started to talk about it, and I believe Apple, can create great like products, like Apple's history is kind of filled. Like, I don't know if a lot of people know this story, but Apple tried to like aggressively compete with Google Maps at one point. And as good as they are with hardware and design or things like that, it was a miserable failure to a point like where they don't really even like point people to maps in the same way. And like there was a story about people going like getting guided to like a desert in Australia at one point because like I don't know, some flaw in Google Maps. So if you're talking about like AI chops, like Apple is not that great. And I'd say that there's like legitimate concerns there. When you see like a core business falling like that, where you see where you basically see something like iPhone sales dropping when other core businesses on like their competitors or their big 7 competitors rising, that's big. That's a big concern for me. And it's a big concern where you're just like, oh, like Apple, like, and some of it is like, I look at it in terms of, and obviously I bragged about how ahead of the game Teslas are in terms of their AI and self-driving ability, because they don't use LiDAR. And they just use kind of a powerful pre-programmed machine learning algorithm. But like, kind of combining like, yeah, do I think Apple could build like a kick-ass looking car, product design, everything like that? on par with like a Tesla? I absolutely believe that. Like, do I believe, based on the fact that they couldn't even really get a maps product right, that like they can execute on self-driving? Like, theoretically they could, but we haven't necessarily seen anything in their tech, especially in like a history like maps, which is like, that's the closest thing, and like kind of like an elementary version of, you know, what a self-driving car would need to run. And like maps is still not that great. I mean, I don't use it that often, but I know not many people use it. And like if their AI was better, perhaps there'd be more of a reason to use it. And they just seem to have punted on that. So yeah, I have serious concerns about Apple, especially relative, like, you know, I strongly prefer Google, I strongly prefer Meta. You know, because even Meta, like, you know, if you're asking about like, you know, what has Meta proven in AI? Oh, I mean, only the kind of the most successful engagement algorithm the world has ever seen. So you know, TikTok, like, you know, you could argue they're starting to be in that. You know, we'll see where it shakes out with Reels. Like, but if you're talking about like Meta and the engagement and their ability to generate like ads, like honestly, I think it is incredible that they've got the ad revenue that they have, and it speaks to their ability to generate engagement. Because like I am not interested in Prospero like Facebook ads. We run some tests for marketing in the past, but like that was like a long time ago, and it's really just to get feedback and engagement feedback. Like if I think of an ad product, like Google is much more interesting to me, because if people are looking for like stock app on Google, they see Prospero, like that's really easy. It's amazing that they get as much engagement and sales as they do, when like I'm not on Facebook looking for stuff or looking to be sold stuff. So yeah, that actually speaks to their AI tech, and I think a lot of people don't necessarily look at it that way. And a lot of the internet, and it is run on something called graph search. Like Google is very much about like, you know, there's PageRank, which is a form of graph search, and like graph search is kind of like the means by which relevant data is served to people in Facebook. So like or Meta or whatever. So like, yeah, I would say that like Meta has the audience, Meta has AI chops, Meta actually, like, while they don't do every product that well, you know, and even just like continuing this resource, and they're trading at a big discount relative, like both Meta and Google, I'm talking about them, they're trading at a discount to forward earnings to Apple and Microsoft right now, or maybe it's converged a little bit, but like it's still the case. And like, yeah, like to me, I think Meta and Google should not be trading at a discount to Apple and Microsoft, because I consider those are the businesses that I personally like more, in terms of like, you know, I would say more Google, deep tech, pure tech, like would not bet against them. That said that time and time again. And I think some of this is like starting to prove itself out. You know, as like people are kind of turning around from the initial like, oh, like ChatGPT is going to win, like ChatGPT is having some, you know, is having some problems, and it is getting dumber, and like that's pretty funny. It continues to get dumber, and like there are interesting copyright infringement cases and everything like that. That's like, you know, I don't know if they're coming against Google, but like, yeah, Sarah Silverman's in one, where like basically like she's seen answers for like ChatGPT that like she thinks is like literally like taking from some of the stuff that she's written. And it's like, you know, sometimes being like the early sloppy mover that Microsoft ChatGPT is, like whatever, just like throwing something out there, is not helpful from a legal purpose. Because like, I'm not sure if Bard is named in these suits, but I know ChatGPT, a lot of people are coming after them. So yeah, like I continue to be puzzled by that, but like Microsoft, I think that like ChatGPT is an amazing product. Like OpenAI, like those people had some stuff figured out before everybody else, and like, you know, they have a head start. They had a head start on the training data, which we talk about specifically for that, is like very important because it's relevant to that Q&A system. Whereas like Facebook kind of has an existing conversational, much deeper conversational, person to person, but like not person to AI training set. But Meta, you know, in a lot of ways we've talked about, can compete there. But like, so I'm not necessarily like as concerned about Microsoft's business as I am about Apple's. But yeah, like I started down this road, but like even if you look at like Meta's like cheap, like I think it's like a $400 VR headset that like Apple says is more about gaming, and Apple's got like the what like I think $3,500 one that's more about like work or whatever. Like, it's great and Apple's Apple, but like, and one thing I will say about Apple that they do better than anyone else, they're great about secrecy. So like that's the thing. Like they could have something in the works that just like blows everything out of the water, which is why I'm not saying I'm betting against Apple. I'm just saying like I would rather own Google or Meta right now at these valuations. I want to be clear about that. But right now, if you look at their business right now, without some new powerful, like you might say Jobsian release, which I would say Tim Cook has not been as good at. Like, if you look at just like new groundbreaking products, that's still, I'd say, more of a Steve Jobs thing than a Tim Cook thing that I would say has held up the design principles and the market share very well, and kind of like the mystique and the recruiting of everything like that. But they haven't had, and few people do like see the world in the way that Steve Jobs does, where he could just like invent products that are just like, 0 to 1, you might call them. That's the big like Peter Thiel concept of just like moving things forward like substantially. And like typically that's reserved for startups, but that was kind of what was crazy about Jobs. I would say he could have like 0 to 1 moments, even within a large entity. And like I think Tim Cook's great. He's smart. He executes on Apple's vision, existing vision very well. But do they still have that ability to just like create like completely differentiated products out of thin air? I'm not sure.
So I just want to mention we have a comment from Mario who agrees with you that the Google Pixel has way better voice recognition than Siri. So he's with you on that. And to put a bow on the Apple topic, so it's pretty clear that from like a trading or a short term perspective, you just are not interested. But if you're someone who's been invested for Apple for a long time, or you're planning on investing it for a decade or more, what's your thoughts on that? Would you just not start right now? But if you're a holder of it for a long time, it's just a position it just should keep stay in your portfolio.
It depends on how many stocks you own. Like this is what I always say in my newsletter. It's like if you're going to own 500 stocks, like Apple should definitely be one of them. I would expect it to outperform the S&P 500 the next 10 years. That like I don't have much of a question of that. Like if I'm owning 5 stocks, like it's probably not one of the 5. Like if I'm owning 5 stocks for 10 years right now, like what I'm looking at is Amazon. And I'll just like run through that quickly. Like Amazon, I just think is the best organized at product rollout, go to market, things like that. They just like have it in their DNA. They're very good and have high success rates of like putting money into new businesses and having them succeed, which is why like that goes beyond Bezos. And I talk about that every time. They're my number one. I don't like them with economic concerns right now, even though they just like made me eat it a little bit, dropping my portfolio on their earnings, which just proves my point, which is like, even with other direct to consumer businesses struggling, Amazon's humming right along. I would also say along those lines, Alibaba, like even without all of these, like if you can own it now, like obviously if it breaks up, the more complicated, but like, I would say that is right there. And like, I would also say Mercado Libre, kind of the Latin American one there too. Let's just grab those like everything stores in all the places. Like it's just where the world is going. And like, if you're already entrenched, it is very, very hard to like compete because the whole game is margins and scale. And like, to start competing, like to take market share away from Amazon now, how do you do it? Like the amount of money you'd have to lose to compete with like any of these like entrenched now, like, when you talk about like Mercado Libre, like can Amazon compete with them? Maybe someday. And that's like a risk, but like I'd see that coming a mile away. Like what I would do on the announcement, anything where like they're gaining a foothold, they're starting to send drones into Latin America, like very easy. Like I think Alibaba is safer in that sense, whereas like Amazon's not going to China. Like that's not happening. So I feel even safer there. And then I would say Tesla. is the other one where it's like for a variety of reasons, just like I would bet on Elon Musk. Like he is, he's just like the guy who knows how to innovate. And we talk about it's like a combination of innovation and actually be able to like grease the reels and getting things through Congress, like, things like that. And then, the last one is like really, it's hard. I like super micro is like creeping up in my mind on NVIDIA in terms of those chips. And I'm really nervous a lot about those. I would love to do those, but I say it and people don't like when I say it, but I'm going to say Meta. Like I am impressed with their turnaround from like their pivot back, back to, kind of going for this, from the metaverse back to AI. And it's just like, they're kind of somewhere in between, I would say. What I like about Amazon, what I like about Tesla, is that like they know how to innovate and they can hit on products like not quite to the extent that Amazon can, but they're kind of like rolling out like newer products as opposed to just like evolving in little ways. And they're very good at acquiring competitors. And like that's just the thing where I'm just like, they did it WhatsApp, Instagram, whatever. Like it's just like, okay, like yeah, maybe something will or copying things like Snapchat, like that's where I'm just like, they might not be the best innovators, but like they are very, very good at growing market share, eating their competitors, and just like making sure that they don't fall behind in those ways. So those would be my top 5 to own for the next 10 years. Obviously it's thematic on that like direct to consumer, like, but that's just like, what's a business that has a huge moat once you're there? We described the moat and like how much it would cost to compete. And like, obviously any kind of like trust busting monopoly is like, that's the biggest threat to those businesses. So obviously you got to watch out for that. But, in terms of just like being hard to compete with, that's it right there. And then, they also just have the market that is going to keep growing. Like, there's no way people are going to start like, more and more people are ordering more and more things through it. It's becoming more and more like easy to do, harder and harder to compete with. Those businesses are just going to grow and it's going to be harder to compete on price with them. So it's just like, they're going to keep growing.
Mhm.
And like, this is all to say, like, where do I put Apple? Like there, like, I don't know. There are like, even like NVIDIA, Supermicro, like there's a lot of these like companies, like, even something like, First Solar or Enphase, just like things that are like more growing businesses. And like my concern with Apple obviously is I'm not sure it has a growing business. So, even something like Microsoft, I would start putting above Apple. Like, this is all to say, like, easily top 20, top 25. I'm not going to keep naming things. So if your portfolio has that many longs in it, like, yes, Apple should be one of those longs. But like, as you're getting choosier, if you're talking about even 10 stocks to own, I wouldn't, for the next 10 years, I wouldn't put it there.
Yeah. Yeah, and one stock you didn't mention, which I wanted to bring up today, for good reason, as they didn't forecast very good things for their business, is Airbnb, who sees bookings and nights declining in the future. And so, how do you feel about Airbnb, but also travel tourism space now that the economy seems to be kind of slipping slightly?
Yeah, I mean, I think Airbnb and like like sometimes growth is your own worst enemy. And I think they absorbed too much housing stock. They made too many enemies in these like local places. Like I have a personal story where I live for free in a beautiful Soho loft from, I believe it was like 2017 to 2018. I was early to the game. Like I loved it. Like I lived there half the time and I could travel the other half and I had free rent. I had some innkeeper responsibilities, but I met some awesome people. And like New York passed a law that made it illegal to advertise. And they were one of the first people to do this. And that made me very nervous because I rented. And like that ended it for me. I was like, no way. Like it was an $8,000 first fine and like an undisclosed second fine. And that place was expensive. And I was like, I was not prepared to like pay, like it paid for itself as long as I could rent it out. But that would have not been very good for me if I couldn't rent out the place anymore. So that's just an example of like the first like assault, and it's happening in like all these places. All these laws are being passed, and I think that like sometimes growth is your own worst enemy. And I just think that like, yeah, like a lot of these places actually specifically, there's flooded short term. Like not only do they make enemies, there's just too much short term rental supply. And like too much vacancy, too much supply means price starts to go down if you're even renting, so it's just like, yeah, it's like there's kind of like a fixed amount. And then, you might have people that that like, yeah, you're getting less revenue. All of a sudden, you're not, in those markets, there's oversupply. Then yes, I think there's like also starting to be like, I would say less, we have the credit crunch coming. We're starting to see signs that people might not want to do as much. Well, that's not true. Booking.com just reported, well, it was, Booking.com just had amazing earnings, and obviously we put them in their newsletter, but Expedia did not. So the demand for that is like, a little, but definitely what we're saying is like, they might have expanded, like, yeah, there's more international markets, but I would say between like laws infringing upon them in their biggest rental markets, where it's just like the hotel lobbies coming along, and that's maybe what we're seeing in like Booking.com. They're having a rebound because like the hotel lobby is in these like more popular places are starting to clamp down. And then, yeah, in these other like growth markets, they could definitely start to see like a lot more, I would say a lot more problems, and a lot more even, you might even say it's kind of even a function of less general tourism to those places. As you'll still have kind of your elite rentals that are going to be obviously making bookings, but like, especially like when we're talking about people that limit more, the lower income people, that's not necessarily like hotels as much as these like Airbnbs. So yeah, I think like, and this is the thing about, and I want to check on, I don't have Prospero in front of me. That sucks. Do you,
Yeah,
if
I
you
could
want to
look at
look
it.
up like their profitability and growth,
Sure.
like what I would say is definitely that,
I
I
got
don't do,
it.
what are they?
Profitability 57, growth 61.
Yeah, so I mean, they're still growing, but yeah, like you want to see, especially like in a tech company like Nvidia, I think that both of those numbers are in the 70s, close super micro. You compare it to like a chip, like even Meta is like an 81 profitability, 57 growth. So you're getting a similar growth, and you're getting a way higher profitability. So I think that like, yeah, like I don't know, and I think people are definitely like concerned, especially as kind of real estate prices start to, and it affects real estate prices.
Hmm.
Like if, a lot of these people, a lot of these places that are designed to have these short-term rentals, maybe there goes from an oversupply to an undersupply, because a lot of these like entities that needed like a certain financial viability from their rentals can no longer exist, and all these like LLCs that sprouted up. So like there's oversupply, and then a lot of them become non-viable, and it also like crashes like the rental market, which further drives down, or crashes the real estate market, which further drives down the prices. I think that's coming sooner or later.
Hmm. Yeah, so now this is a really interesting what I'm about to spin to, because so rentals are pretty expensive, and Airbnb's like their product is like an upper end luxury product. But then you have a company like Elf, which you covered in your newsletter, that I guess their products are slightly less expensive. I'm not exactly sure how much their makeup stuff is, but they have been absolutely crushing it. I think their stock is up like over 400% in the past year. I think they've raised their guidance like two quarters in a row. So how do you like separate Airbnb's vision on how the economy is going in the future and then Elf stock, which are kind of both luxury items?
I think you've brought up like a really good difference. between like a product in their growth curve, right? And I
Mhm.
think in their adoption curve. I think like, and there's a difference. Like I can say like I expect the retail market to go down, or like makeup sales or like whatever to go down total. But you know, a company like Elf that's just like gaining and gaining market share, that doesn't necessarily matter to them because they could still in a shrinking market grow their grow their revenue and grow their profits. And I think that's, I think that's what we're seeing, where it's just like, if you've kind of like started to saturate your market and you're not in this like period of like, growth, user acquisition, whatever, and you kind of see that in more mature businesses, which they are not, there's room for a tough economy. And like, honestly, like, that's why I was like, I debated a bit whether to keep Elf in the newsletter this week. And I'm glad I did, because I was just like, I'm not that bullish on consumer spending, especially consumer discretionary, which, what is that? Like, that's consumer staple is like your goods that you just have to buy. And consumer discretionary is more luxury items. And I am not bullish on consumer discretionary. And the nice thing about Apple and Amazon, as we've talked about, it's kind of both consumer discretionary and consumer staple. So it's really hard to look at that as a business, because especially, just so people understand, a lot of the times in a tough economy, credit crunch, that kind of thing, people will move from consumer discretionary products to consumer staple. Like even something you can think of like going out to dinner versus like buying groceries, or like, things like that. You can see that. And obviously like Amazon doesn't like necessarily, that's not as good of an example. Let me think of a good like consumer staple. You know, Amazon, like this is like maybe a classic example, but like 2-ply to 1-ply toilet paper. Like Amazon is selling them both. They don't really care. Like they're making a little more on the 2-ply. Like, but they're not losing your business if you're like cutting down on your like toilet paper. I don't know if like if 2-ply toilet paper is officially considered consumer discretionary, but I think the listeners will get it. But yeah, that's like something I'm particularly proud of, to be honest, in terms of like the Elf pickup, because like a lot of what I would say net option sentiment especially has been picking up this year has really just been tech stocks, and that's what people speculate on the most. Like we talked about earlier, like growth tech, like that's where you're going to make the most money on options. So whether you're retail or an institution or whatever, like, to contrast that, if you want to buy a bank stock, if you want to buy, say, like Coca-Cola, like you don't really want to own options on those stocks, because if you own options on those stocks, you don't get paid dividends. Like, so really what you want to own in like longer term options are growth stocks that don't really pay dividends. So it's going to skew to that way. So when I saw Elf, high upside breakout, high net option sentiment, like obviously the growth story is there. Like that was like, I was like, oh, let me dig in a little bit. And what I saw, I really liked. And I even talked to a few of my like makeup using friends and asked them. That's called value investing. When you go and you talk to the market, and like at the very least, everybody had heard of Elf. Like I was like, hey, have you heard of Elf Beauty? I haven't. And like, oh yeah, like actually one specific like, oh, there's a big influencer that just like had a big Elf shopping spree. And I was like, oh great, that's what I want to know. Bye. Like, like that's actually like what's called deep value investing, when you actually go in and you like look at the product. Value investing is kind of like looking at the numbers very hard. Deep value is more like diving into the product and the use and understanding like what the growth story is, and if like the growth is properly being, if the growth is properly being forecasted, and then B, and the much harder thing, and we talk about this all the time with anything, how much of the growth is built into the price. And really that's just like, that's more of an eyeball thing, because like if the growth is built into the price, part of the calculation that you're trying to make there is like, how excited are people going to get about Elf, like to grab more market share? You have to make that kind of calculation in your head, because you could be like, okay, here's the growth rate. And then you're just like, okay, here's the growth rate. How much are people going to forecast? Like if this growth hits, how much more excited about it are people going to get? How much more growth could they potentially build into the stock? And that's one of the toughest things to ever do. And like, with Elf, it's challenging. With something like Tesla, it's damn near impossible to be like, how excited is everybody going to get about Tesla if they double revenue next year? It's just like, oh, I don't know. Like, 5 times as excited, 7, it's
Yeah.
like, it's impossible to do those numbers, especially when you have like the frenzy of people and the meme stock and the Elon Musk of it all. Like, that's why it's like Tesla is like the hardest stock to predict, and why I'm just like, it's kind of how I feel like a lot of things in the stock market. But like, whenever I see people so sure, like Tesla's going to go up or Tesla's going to go down, I'm like, good for you. I've been doing this a long time. I'm like, I am not that sure. I look at Nvidia very similar right now. It's just like,
Mhm.
I'm very nervous about saying either direction right now. So it's like really funny when some like person that's been like looking at stocks for 2 years, like Tesla's going to double by the end of the year. It's like, okay, good. I
Yeah.
admire I admire your confidence.
That's the type of people that gets me nervous when a stock has those kinds of people in it. And then when they get bored by it, they sell it. And it's like, oh, well, that stock is kind of overinflated. But Prospero seems to be doing pretty well at predicting. Like you're saying, it's very difficult, but Prospero's doing a pretty good job. And you also had one other stock I want to mention was my Moderna. You had a pick for Moderna. So,
Oh man, yeah, what a hit.
mhm.
That so like the story there. And I like the newsletter this week was probably the toughest newsletter I've ever had to write. And not only was it like dropping, like not only was it dropping, I want to see the live for Moderna because like oh, it's having such a bad, oh, it's not even as bad. Not only was it hard for me to like, for the first time, I would say let go. Like Meta made it a little easier because its net option sentiment went down to 58. But like letting go of Tesla when it still had like a 95 net option sentiment. And I think the upside breakout had gone down to 79 and was not in a good trend. So there was other things, but like that was a tough call to make. It looks like the right call, but basically I was ultimately like, no, I don't buy tech right now. I think the whole thing's so overvalued. And it's just like, yeah, there's some things, and I explain this to people all the time. It's just like, and I think I did this a few weeks ago, but just to review, some people are just like, well, why don't you just say like upside breakout means the stock is going up, like the highest ones, whatever, because I'm just like, well, in a bear market, a stock that has 100 upside breakout could have a return of 0. And that might be really good relative to everything else. So that's why, like, it's always relative. I always situate. And it was just like, no, I could not get excited about tech based on everything. We had a QQQ net option sentiment sitting at 9 at the end of the week, touching 0. I've never seen it touch 0. Like SPY back to its like 0 at the bottom. Like, could not get excited about the market. And then like I started looking at filters, and I shared a pretty interesting filter where I was like looking at, I think it was just like the biggest one I've ever done, where I did like the 6 most important, I wanted new bear picks, and I did the 6 most important signals. So it was like upside breakout, minus downside breakout, plus net options, plus net social, plus profitability, plus growth. Biggest one ever. And I actually eliminated a bunch of stocks. I eliminated small cap biotech because like I have no taste. Like I don't actually have the time or like the effort. Like if I'm gonna have to hold it for a week, those can go off the rails way too fast. And then what I basically was left with, like, was Moderna sitting there right at the top after Rackspace, which was a great bear pick that we had the week before, but it's reporting. And I have zero taste for dealing with earnings right now. I call it an embargo in my newsletter. After like, I think we're going to talk about this anyway, but after Confluent had this big, like I got into Confluent and all of these cloud things were guiding up. And that's why I got into Confluent. And I was like, oh, Confluent's like definitely going to guide up at their investor day, June 13th. They did not. The stock went down 7%. So right before earnings, I was like, I got to bail. Like they guided down last time. And then what I thought was going to happen the whole time, they finally guided up. And that's just like annoying because it was like a month ago. Sometimes people play games with the markets, and that's really annoying. They like intentionally guided down to like generate more buzz, I guess when they needed it, like a month later. They knew that they could have made that guidance at the investor day. I'm actually pretty annoyed by them, but it doesn't matter. Yeah, the model portfolio is doing fine. We're still up close to 100% over the S&P 500, which actually I realized I did a short calculation wrong. So I actually had it at 76, but we're actually at 87. So we're still doing great. But basically, like I saw Moderna right there at the top, right under Rackspace. And what was interesting is like a lot of the other stocks had higher downside breakout, and its downside breakout was only 46. But then I was like, oh, if it's number 2 and its downside breakout is number 46, it must be horrible in the rest of the stuff. And I was right. And I've invented this new filter that I'm gonna look at a little bit more now, which is called like the bad business, and both retail and institutions don't like it because like Moderna's profitability plus growth plus net social plus net upside, plus net options was 61, which basically means those numbers are averaging 15, which is just like objectively horrible to be like that low and everything. The next one up, we also shorted, which was at 90s in our bonus picks, which was 97. So 36 away from that. And then there was like a big like chunk of ones after that. So Moderna was just horrible. So like, that's just another example. And obviously it's down close to 10% today. Feeling really good about that pick after like honestly feeling guilty about what happened with my bonus picks last week, which was basically like, I had this like sound the alarm on 9:30 at open. And I basically had to make the choice of whether I like redid the whole bonus pick portfolio or I was late to deliver news, because obviously bonus picks and picks go in one thing. And I made the difficult choice of just like updating just the main picks and not the bonus picks. And now my bonus portfolio, like obviously the whole downturn hit the bonus picks portfolio. It's not doing as good. I feel good about what I did for the readers to get it out on time. And like I sounded the warning on tech. So hopefully that was good enough. But sometimes these things just move really fast. And like, sometimes that's why it's easier to manage a smaller portfolio, and why I gear towards that myself, because I can do deeper research on fewer names. I know all of them well are going to hold for the week. Like even things like earnings and reports can get challenging when I'm like moving through like that many names and like not being able to get that timed right. But yeah, Moderna, like I'm very proud of that pick. And it looks like it could go on a good run down, because there's nothing really good. Like there is like a 19 profitability and I think a 9 growth. Like there's nothing really good about that business. And obviously we're expecting a little bear run here, and I think we're going to transition to that. But yeah, really like, and to wrap it up, the other thing that I saw was just like biotech on the top of that filter. And obviously it's going to be lower profitability and growth, but it doesn't necessarily have to be net options and net social, which just told me that like nobody in the institutional options markets, nobody in social sentiment were speculating, like in the retail markets were speculating on these stocks. So I was just like, okay, like if it's that bad in all these filters, it's a good time for more exposure to biotech going down. And another one of the picks, I think NNOX, was like a medical imaging company. So it's like biotech adjacent. And that's having a pretty bad day too. So yeah, we increased our exposure, and normally that scares me more to have that much exposure, but not when I'm just like, oh, like nobody likes these stocks. Like there's no support. There's no one like, if there's no institutions like long options on stocks, like that is big problems for like a day that starts today, because there's nobody ready to like buy up. Like, and we've talked about this, like a big reason to buy up shares for institutions, like especially ones that make a lot of their money on options, which many of them do, is to be defensive of your options positions. If you want to own a bunch of call options and the stock starts to go down, you got to stem that drop. Otherwise, you could be talking about some major losses on those options. So yeah, like basically seeing that, I did not mind having overexposure to it looks like we have some questions that I saw, but yeah, I don't mind overexposure. I think you had some other questions, but we can go to
Yeah, you want to go to the chat first because we have Wolf Stigma asking like, how did you see those filters? Are they on Prospero or did you calculate them manually? And I think you've said before they're going to come in the future, but they're not there yet, right?
Yeah, I'm gonna start having like a daily filter. That's just my favorite one. That's gonna go in and fire an alert. That's like the number one priority on our roadmap. But for now, like the best place to find them is like on the on the premium newsletter. And like yeah, I said to the readers, if you want to like reach out to me, like build a like I can send a discount code to the premium newsletter. Um, and yeah, I would say the only other thing about that specifically is that uh I take requests. Like if people want to see certain filters in the premium newsletter, I'm happy to like throw them in. Like I've said this before. But yeah, like that's at least 2 times a week. But especially like on the Discord, on the one, like there's a crowdsourced portfolio that's like volunteers and people that pay for the paid newsletter. I'm happy to start throwing filters into that. So yeah, just like if you have more questions about that, we can do that.
Yeah. And then we just had John Lopez who said he's been scalping Nvidia for the past month and he's been killing it, looks like. So good for you, John. He likes Nvidia.
Yeah, we don't like compared to like some of the other ones that I mentioned that could be in like my best stocks for like the next 10 years. We definitely have like I did not mention Nvidia in that same thing because we just tend to see like not a lot of like versus like Meta, Tesla, we see a lot of institutional like net option sentiment or long-term option sentiment within upside breakout, like pro those names. We don't see it as much for Nvidia. Actually, more often than not, it's in the short-term bets right now, but it doesn't look like anyone loves options at Nvidia, like long-term options in Nvidia at these prices, which means I think institutions are expecting a correction at some
Mhm.
point.
Mhm. Yeah, and speaking of the correction, you shared one of the craziest charts I've seen in a long time with the divergence between the Nasdaq and I think the 10-year yield. And if you want to like explain why that is so indicative of what you're seeing in the future of the stock market and how crazy it is.
Yeah, that kind of blew me away, to be honest. Like, because I mean, I think that was more of a short-term chart than the history, but I think let me just look because it's not always like macroeconomics is very complicated. And
Mhm.
it's not always like a one-to-one ratio of that kind of thing. But I want to take a look. I want to see like how far back, because now you've got me thinking I misremembered it.
I believe it was like
But I will take a
2021,
look.
something like that.
No, yeah, that chart I was remembering it correctly. We're just talking about going back to July
Oh, okay.
of last year. Yeah, it looks like July. So yeah, basically what we're looking at there, like July 2022. And basically what we're looking at is the Nasdaq 100 um climate like performing pretty close to the 10-year yield. And we're seeing a huge divergence now with the yield being lower, which means there's a big gap to cover. And especially for like, what I will say about the move down in like September 2022, you do actually see the yield moving down pretty aggressively prior to the aggressive move. So there is even recent precedent of that being an excellent predictor. But like even that much divergence, talking about it more historically, as I said, there's reasons for divergence, like, but and a lot of times it is over speculation on growth multiples. But yeah, that is a downright. I was kind of like debating how bearish to go, and I think I'm 2 longs and 5 shorts in my um in my main newsletter, and I think I'm like 2 or 3 longs and like 8 or 9 shorts in my bonus picks. So yeah, like I was going back and forth. Like I was like, is this aggressive? Because I don't love to short the market, I'm like, even if I'm pretty sure about it, I don't necessarily like to aggressively short it. Like what I would prefer to do is like do like 2 to 1 or 3 to 1 versus like tons of exposure like I'm doing now. But like after I saw that, I was like, no, I just think it's like, that and an option sentiment on QQQ and SPY being so low. Like, yeah, it just seemed to me like not worth the risk to not go short, to remain long. And like, yeah, it does look like I am pretty pleased with myself that not only did I go heavily short, the 2 longs that I picked, our longs that are up today. Yeah, booking is doing well, and I think Elf is still up, but it's receding a little bit. But like, yeah, I think that like we are. It's a pretty scary. Oh, they want to share a screen. Well, I can here. Let me post the picture of what I'm talking about, because then I think people can see it. As opposed to just like walking through. Sharing our screen has not historically been very helpful to us. For whatever reason, it like cancels out the video, but I hope I can post this picture here. Am I able to? How do we post a picture?
Do you want to post it in YouTube?
Yeah, I guess we can't. All
Um,
right, maybe I'll break the rule, and I'll like
yeah, if we just
I'll show it briefly. This is the graph that we're looking at. Um, Basically, you see that it tracks pretty well. This is where it's leading down the 10-year, like, or sorry, the yeah. So we start to see this drop, like it's going way up, and we actually start to see the drop before this drop. So yeah, we have an extended drop during a raise, which means we might be due for a really big correction, which got me concerned. I don't want to be behind that, because like with this kind of thing, this is the kind of thing where the market could like snap. Like, the QQQ could be down 5% in a day or 10% in a week. Like, that's why I just do not want to be on the wrong side of that, and why I got very, very conservative, because it just doesn't see like, with how overvalued once I confirmed it with like the earnings, and I saw it in the options markets, and all of that started to add up, I was just like, I can't, like, I don't know how I can't be like super conservative in light of all of that.
Mhm. So yeah, so one thing I wanted to ask you about the new stance is that, and you kind of mentioned Confluent before, but so there's been an AI boom this year, no doubt. And is this recent bearish turn you're having, do you see that as a short time frame, and then the AI secular like bull market continues, or is this a prolonged downturn?
Well, September is traditionally a pretty good month for the markets, like everybody coming back like from their summer breaks, and like Wall Street, like August is kind of a dead month.
Hmm.
So like on that, like, I don't know. There could just be a rising tide there. Like, I would say that I think, like, to actually wrap something up and get a little more clear with what I was saying earlier, the fact that the S&P 500 was so overvalued, trading on such a high earnings multiple. Like, if you back into that a little more, it's like, what in the S&P 500 do we think is trading at those really high earnings multiples? And obviously that's tech. And obviously that's tech that touches AI even more. So you're basically talking about like that specific bubble is so massive that it's inflating the whole earnings for SPY, which is why you're seeing like some large cap non-tech still perform like pretty well the last couple of weeks, even as the market is going down. So I think that part is like pretty important. Um, and yeah, like what I would say there is like, is the AI bubble over? No, I mean, I think we're gonna still get like this, like it's still legit businesses, and that's what I'm saying. It's not the .com bubble. These are real businesses that have a lot of growth potential, and touching different things, from like whether it's just like something like ChatGPT to self-driving cars to just like more
Hollywood,
automation and just what?
the Hollywood.
Yeah. Oh God. Well, it's yeah, exactly. Um, there's so much there's so many opportunities there that it's just like it's hard to say like there's an AI bubble.
Mhm.
Like, I do think that things got overvalued, and there is a correction. There's a correction coming. And like honestly, it was like it's one of those things that sometimes it's like it's even hard. Like, it had all the markers of a bull market. Until kind of this stuff started to add up, and like more and more of like the realities of what was ahead of us, and like the like still a likely recession is coming through, and like I think we've probably hit the bottom of the market. Some people say like probably, but it also looks like it also definitely looks like that it's going to be some I'd say August, I'm pretty confident that August is going to be rough. But
Mhm.
September is going to be a really important thing to see. And obviously, we'll be talking about it as we head in to September, like whether or not we've seen things to start turning around. But I expect to be, I'm not sure what could really turn me around
Mhm.
on like becoming bullish, like other than like some hurt, like some hurt being placed on the markets, and then seeing that start to turn around. Because we do need to see those valuations become like more reasonable. And like, I think the important thing to realize here is that a lot of these tech companies guided up. Like a lot of them reported strong earnings.
Imagine if they didn't.
Like what?
Imagine if they didn't, how bad the market would
Exactly.
be.
Yeah. Yeah, exactly. Like what I've heard a lot is like they've guided, like people are a lot happy with what they're seeing on the profitability side than the revenue side. So that is something interesting, especially if you talk about like these cuts, like these job cuts and everything like that. But yeah, I would say that like that I'm concerned. Like I could definitely see a hit and then the market coming up and then like you never know. Um and then a lot of it's just got to like some of it's just got to play out because like here's the thing about like some of these intertwined events, and we've talked about this a little bit, like let's say there is a recession and people are starting to cut more headcount, but like buying more like AI services, replacing it with more, computing, things like that. That self-driving cars, like there's a big announcement they start to roll them out more, something like, things like that. Like, I think are going to that could be the balance,
Mhm.
where we could see another big tech boom if there's more evidence that these businesses are like growing. And like someone that I know, like a source of mine in a big tech company, basically was like, we can't buy enough like Nvidia chips. Like we ask for more, we can't get them. So like, that could be something where it's just like, okay, like, maybe Nvidia isn't overpriced. Maybe a lot of people know that kind of thing. So like, it's a little touch and go, especially as it goes for AI, where like the numbers just have to play out. And I don't think any of us really have the answers here, because that is a very like there's two big factors, like I would call them levers at play here. It's just like how much actual growth these businesses have to do in AI. And like we talked about, some things could be like, even if headcount gets cut, that could result in more AI growth, you know? And I would say like the other part of that is like how much is like a recession or like job loss, credit crunch, how much is that really going to put a hurt on retail investors? Because, even in the scenario where AI companies are reporting more, like if dollars are being taken out of retail investors' hands, and like a lot of like what even started this run was like retail investors getting involved in AI, if they're selling, like even with increases, we could see a down market. But I would say those are the two levers. And why like I rarely will look that far ahead in the
Mhm.
market. Like I'm talking about a month. Like even when I built a growth portfolio, I felt really good about that and about building a growth portfolio. And even that we were talking about like, we were really just talking about something like 3 months that lasted. And that was like me feeling great about that. But yeah, it's definitely something that it's like very hard to stay entrenched in something like that.
Yeah, and it's why viewers of this live stream are going to have to stay tuned see how we switch up over the next coming months, and because we're playing it by year here. So, but okay, so one other thing I want to touch on. So we have CPI this week, and oil seemed to have bounced a bit in the past month, and obviously CPI in the past year was everything to the market. So, what do you expect of this CPI report, and how important even is it at this point?
I mean, I would expect it to continue to be positive, and I think, yeah, to your point, I think that this exuberance is around the assumption that we're getting inflation under control and where we want it to be, and like getting close to that like 2% level that Powell talks about and wants. Like the way I see it is like we could get some little bull runs, especially if they beat. Like that's, I think, our best hope of turning this around, like a good inflation beat. But I don't even think that would necessarily, like, I think we've started to get some bearish momentum. On the flip side, if like inflation goes in a direction that, in like, if we miss and we don't have the handle on it that people thought, that could really accelerate this situation.
What about if we miss to the downside and inflation, we actually start to get deflation? Isn't that really bad for like growth companies?
Yeah, no, I wouldn't say.
Not really.
Like, I don't think we'll get. I mean, I don't think it'll go that. I mean, no, I don't think. Like, A, I don't think we'll get it. B, I don't think that would be super bad for them. Like, because if interest rates went down, like especially where they are right now, like if we actually, like if they're forecasting that rates would decline, more money would go into the equity markets, like no, I don't think. And obviously if it happens, like obviously if you start talking about like disinflation when like rates are already low,
Hmm.
that's more of, you're talking about like the problem. But because yeah, but like I like right now, I don't think like that would actually really help. I think one of the few things that could actually really help.
Okay, so let's hope for that then. So Wolf Stigma is asking, how long do you normally hold a position?
It really depends. Like me, like personally, like A, I would say that like everybody should invest like themselves. Nobody should invest like me. I've been a professional since I was 17 years old. That was 20 years ago. So you shouldn't be copying me. You don't have my knowledge base. If I'm talking about like generally what I would recommend for anyone, I would say with less than 5 years of investment experience, like I would buy your favorite longs and like buy more, especially right now, SQQQ, like based on how bearish you are. I think that is the easiest, best way. And like right now, I might even say what I'm seeing. I might even say you put 65% of your portfolio in your favorite longs and 35% in SQQQ, like
Hmm.
based on what I'm seeing right now. But like Prospero, you can really use, like you can use it if you are, and we like to support trades, right? We like to support people's existing strategy. If you are already trading on a daily basis, net option sentiment, changes in that, really helpful. We've actually back tested that. If there's a 25% or more change in a moving average of a single stock and their 7-day moving average, and you hold that stock for a day, there's actually a 530% return when that moving average fires. So I mean, it is a pretty reliable signal, especially if you're talking about the difference from the moving average of a net option sentiment, which is obviously not something we have embedded in the calculation today. But what I would say is that if you trade that way, net option sentiment can be great. But for anyone, like anything, just like an easy number, anyone less than 5 years, I really would recommend, like, especially in this market, you have your longs, or like if you don't even want to pick longs and you just want kind of like low stress, like you could just buy like the SPY or the Vanguard total return. But if you want to pick stocks, that's how I would recommend picking stocks right now. About 65%. I would gear towards stocks with high profitability, high upside breakout, and just plan to hold them for a year. Hold, like I said, 65% of that, 35% SQQQ, until like basically QQQ net option sentiment is going back into, at least away from the bear zone or into the bull zone.
Hmm. Yeah, and I think that's great advice for people who are just getting their feet wet in the stock market. And it was good to see a lot of comments today. Thank you for all your comments, everyone. We love answering the questions, and we hope for more.
I'll give him one more because it seems like he's asking like, I would say don't ever let anyone like, especially if you're making money, there's no wrong way. And like anyone that's like lecturing you on that is dumb. But I would also say don't get greedy and don't assume like one of my favorite books on investing is called Fooled by Randomness. And it basically means like the book is like a lot of people confuse luck and skill. So just because you're making money doesn't mean you're right. If you have a process that you repeat to make money and you're not just like haphazardly buying things short term, like that's what would lead me to believe that you have something that you can repeat and that you should be doing. But like you should trade how you're comfortable. And Prospero is great to support however however that kind of works. But yeah, I would say be very careful. I would say like if you're going to go long, like if you're going to own options, I would say always hedge. Whether it's like also buying like, whether it's like a call option that you also are buying SQQQ, or you say buy, 3 calls to 1 put. There's different ways to hedge or buy like 3 calls on a tech stock and a put on the QQQ. Yeah, I think that like that is the best way to look at it.
Hmm. And yeah, John Lopez, good talk. Good luck with your trades, everyone. Yep, we had a good live stream today. Wolf Sigma is still asking.
No, he's I think
Complimenting.
he's I think it's a compliment. Thanks, Wolf. We'd love to have you back. Appreciate the questions. Especially good because like I think when we get questions, a lot of people have those same questions, so it's really helpful for people. All
Hmm.
right, but I think we are signing off now.
Yeah, so thank you everyone for watching. We'll see you next week, 11 a.m. We're going to be live on time every Monday going forward. So see everyone then.
Yeah.
See